Welcome to the deep dive. Today, we're not just looking at financial statements, we're putting on our detective hats, really, to uncover the real story behind the numbers. You
Exactly.
know how those headline figures, they can grab your attention, right? But they often just scratch the surface.
hmm Just the cover of the book.
So, our mission today is to understand how the pros go way beyond those initial numbers, how they truly dissect a company's financial health.
Right. They're reading the whole story, looking for patterns, relationships, how it all connects. It's the real narrative of the business, not just the flashy headlines.
So we're moving past just knowing what the numbers are. We're diving into how experts use these statements to really get a handle on how effectively a company is being run. We're talking management effectiveness.
Yeah, it's key.
And also what key metrics act as their sort of go-to analytical dashboard.
Yeah, and importantly, we'll also be pointing out some red flags, the little inconsistencies maybe or oddities that would make a seasoned analyst, sit up and take notice.
Okay. It's
Uh-huh.
about seeing past maybe the polished exterior.
Exactly.
Mm.
Spotting potential underlying issues.
All right, let's jump straight into management effectiveness then. This is where we start to see how the folks in charge are handling the resources they've got.
hmm
The fundamental idea, really, is that a company's financial statements are essentially a report card on how well management allocates capital. Like, are they getting an A plus or maybe a C on using investor money?
Absolutely. And a really critical grade on that report card is return on invested capital, or ROIC.
Right, ROIC.
Professionals don't just glance at one year's ROIC, they track it over several years. You got to look for the trends.
So, is the company consistently generating strong returns on the money it's actually putting into the business?
That's the question. Is it creating real value? That trend tells you a lot.
And it's not just about making a profit, is it? It's then what they do with that profit.
Precisely.
Like, take share repurchases. Buying back stock sounds good, maybe, but the pros dig deeper.
They have to. Was it the right time? Did they, overpay? Were those buybacks really boosting shareholder value?
Or was it just propping up the stock price because they didn't have better ideas?
Exactly. Timing is critical there. And, similarly with dividends, it's not just the current payout. Professionals do what's called a dividend sustainability analysis.
Sustainability, meaning.
Can the company realistically afford to keep paying that dividend or maybe even increase it based on its actual cash flows and profitability? Is it sustainable?
Gotcha. And then acquisitions. Companies grow by buying others, but, well, we know a lot of those deals don't really pan out.
That's very true. Professionals look closely at the track record. How did past deals integrate? Are there potential goodwill impairments lurking on the balance sheet?
Goodwill impairments sounds a bit ominous, like admitting you overpaid.
That's essentially what it is.
Hmm.
Goodwill pops up when you buy a company for more than its identifiable assets are worth. If that acquired business doesn't perform, you might have to write down that goodwill, and that hits your earnings.
Ouch. Okay. What else signals management effectiveness?
Well, executive compensation is a big one. How are the top people paid?
Mm-hmm.
Is their pay structure really aligned with long-term shareholder success?
Mm-hmm.
Or are they maybe incentivized for short-term bumps that could actually hurt later on?
Good point. And what about insider ownership when management owns a chunk of the company themselves?
Yeah, insider ownership trends can be quite telling. If you see management consistently buying more shares, it could suggest they're confident.
Okay.
Conversely, if they're selling consistently, well, it might raise some questions. It's not definitive, of course, but it's another piece of the puzzle.
So really, we're looking at two different kinds of companies conceptually, aren't we? One that consistently takes capital and generates returns above its cost of
The
capital.
value creators.
And another that might be growing revenue, but maybe isn't being very efficient with its investments, could even be destroying value.
Yes, exactly. A company consistently earning an ROIC well above its WACC, its weighted average cost of capital, that's the goal. They're proving they can deploy capital effectively. The opposite, a company with ROIC below its WACC might actually be shrinking the pie over time, even if revenue looks good.
Okay, that makes sense. So we've looked at assessing the decision makers. Now let's zoom in on the specific numbers they track, that analytical dashboard you mentioned, starting with cash flow. Seems logical. It's the lifeblood, right?
Absolutely. Couldn't agree more. One key metric here is free cash flow divided by sales, FTF sales.
What does that tell us?
It shows how efficiently the company turns its sales revenue into actual usable cash. Cash you can spend, reinvest, or return to shareholders. A higher ratio is generally better.
Okay. And then free cash flow divided by net income, FCF net income.
This one's about the quality of earnings. If reported profits net income are consistently way higher than the actual cash-generated free cash flow, that could be a bit of a flag.
Why is that?
Well, it might suggest those profits aren't quite as solid or available as they seem. Net income includes non-cash items, accruals. Operating cash flow is closer to the cash hitting the bank account. A big growing gap needs explaining.
Like a mirage, maybe? Looks good, but isn't quite real.
That's a good analogy. Another one is looking at operating cash flow growth over time, maybe a 3-year Seki jar, compounded annual growth rate.
Right. The trend again.
Exactly. Is core cash generation growing healthily, or is it sputtering?
And the last cash flow one you mentioned in the outline was the cash conversion cycle, measured in days.
Yeah, the CCC. This measures how long it takes, on average, for a company to turn its investments in inventory and other resources into cash from sales.
So faster is better, more efficient.
Generally, yes. A shorter cycle means they're managing their working capital efficiently. Money isn't tied up for too long.
Okay, let's move from cash flow to the balance sheet. It holds crucial clues too, right? Financial structure, stability.
Definitely. Debt is a big focus. Net debt divided by EBITDA is a really common one.
Net debt to EBITDA. What's that telling us?
It gives you a sense of leverage. How many years of current earnings before interest, taxes, depreciation, amortization would it take to pay off all the company's net debt? Lower is generally safer.
Makes sense. And related to debt, the interest coverage ratio.
Yeah, this shows how easily a company can cover its interest payments with its operating profits, usually EBIT or EBITDA. A higher ratio means more breathing room, less risk of defaulting if earnings dip.
Okay. And liquidity. Always important, especially short term. Current ratio, quick ratio.
Exactly. The current ratio compares short-term assets to short-term liabilities. Can they pay their bills coming due soon? The quick ratio is stricter. It takes inventory out of the assets because inventory might not be easily converted to cash quickly, gives you a tougher look at immediate liquidity.
And then there's goodwill and intangibles as a percentage of total assets. We touched on goodwill earlier.
Right. This just shows how much of the company's asset base isn't physical stuff. A really high percentage might warrant a closer look, especially if profitability seems weak compared to the value assigned to those intangibles. Are they really worth that much?
Okay, got it. Let's switch gears again. Revenue metrics. What tells us about the health of a company's top line, its sales?
Well, organic revenue growth is super important,
Organic, meaning?
meaning growth from the existing business operations, excluding the impact of recent acquisitions or divestitures. It shows the underlying pulse of the core business. Is it growing on its own steam?
Right, not just buying growth. What about revenue concentration, like top customers?
Yes, looking at the top 5 customers, for instance. If a huge chunk of revenue comes from just 1 or 2 clients, that's a risk. What happens if they lose one? Diversification is generally safer.
Good point. Deferred revenue growth rate, that sounded interesting earlier.
Yeah, deferred revenue is cash received upfront for services or goods not yet delivered. Think subscriptions. So if that deferred revenue balance is growing strongly, it can be a good leading indicator for future recognized revenue. It suggests future business is already locked in.
Okay, like visibility into the future. And finally, days sales outstanding, DSO.
DSO measures the average number of days it takes to collect cash after making a sale.
So you want that number low.
Generally, yes. A rising DSO could mean trouble collecting payments, or maybe they're offering looser credit terms just to boost sales numbers, which isn't always sustainable.
Right, fast growth but slow collections, like pouring water into a leaky bucket.
That's a great way to put it.
Okay, next up, profitability metrics. How well do they turn revenue into actual profit?
Okay. First, the gross margin trend, maybe over 5 years. How profitable are their basic products or services after the direct costs? Is that margin holding up, improving, or eroding due to costs or competition?
And comparing their operating margin to the industry average.
Crucial for benchmarking. How does their core operational profitability stack up against peers? Are they more or less efficient in their main business?
What about incremental operating margin? How's that different?
This measures the profitability of additional revenue. So for every extra dollar in sales they get, how much drops down to operating profit? A high number suggests good operating leverage. Fixed costs are covered, so new sales are quite profitable.
And tracking SG&A selling general and administrative costs as a percentage of revenue.
Yeah, it shows efficiency in overheads and operating expenses. Are they keeping those costs under control as the business scales? or are costs growing faster than sales?
Okay.